This time, in this video, we are looking at what is a recession and a depression. So first of all, we'll look at what is a recession. As a recession is a period in the business cycle where economic activities is in general decline. So this results in elevated unemployment, falling income and consumer spending, rising business failure and falling stock markets. Now, a recession is a normal part of a business cycle, yet the economic pain can cause major effects that affect the economy. Now, this is due to a number of companies or banks failing and becoming no more, the government or monetary authorities implementing their response to the economic downturn, and social upheaval resulting from widespread unemployment. Now, when there is a recession, there is consequently a drop in 5 economic indicators. So the first one is real gross domestic product. Now, real GDP takes inflation into account to show the true growth of the economy. Then you have real income, and then when it says real, it also takes inflation into account. Employment, manufacturing, and retail sales. Now, the stock market in itself is not an indicator of recession because stock prices reflect the anticipated earnings of public companies. So instead, a falling stock market would be the result of a recession because investors lose confidence in the economy. So now let's look onto what causes a recession, as there are many different reasons to why a recession is caused. Now, the first one we'll look at is a credit crunch. Now, a credit crunch refers to a decline in lending activities by financial institutions brought on by a sudden shortage of funds. So this often follows a period in which lenders have been overly lenient and they then become scared of bankruptcy or defaults, and it is made nearly impossible for companies to borrow money. So this means that business have to scale back operations and trim their workforce. And this means that productivity decreases and unemployment rises, which are 2 indicators of a worsening recession. Next is higher interest rates. Higher interest rates will reduce borrowing and investment. So for example, in the early 1990s, the UK increased interest rate to around 15%. Now, this caused mortgage payments to rise and consumers had to cut back spending. Deregulation is also a reason of recession. Now, lawmakers can trigger a recession by removing important restrictions on banks. This can lead to excessive risk-taking. For example, when the Glass-Steagall Act of 1933 was repealed in 1999 by the Gramm-Leach-Bliley Act. Now, the Glass-Steagall Act prohibited retail banks from using deposits to fund risky stock market purposes. Now, this meant that financial firms started to invest in risky derivatives to increase profits, which obviously has a larger risk associated with it. There's also poor management. Now, this is generally just bad business practices, often cause recessions, and this can include fraudulent activities and questionable loans. Next is when asset bubbles burst. Now, asset bubbles occur when the price of an item becomes inflated beyond their sustainable value. Now, this bubble will therefore set the stage for a recession to occur when it bursts. So for example, in 2004 and 2005, people thought that housing prices could only go up, and low interest rates helped create this housing bubble. Now, many people also bought homes that they couldn't afford thanks to interest-only loans. However, in 2006, the bubble burst and bankers lost trust in each other because they didn't want toxic mortgage loans as collateral. Now, this was a major reason for the collapse of several financial institutions during the financial crisis of 2007 to 2008. Next is deflation. Now, deflation is the opposite of inflation, and prices falling over time can have a worse effect on the economy than inflation because it reduced the value of goods and services being sold in the market. So this encourages people to wait to buy when prices are lower, and this means that demand falls, causing a recession. Now, the final one we'll talk about today is a black swan event. Now, this is an unexpected event that is very hard to predict. Now, at the time of filming this video, we are currently in the COVID-19 pandemic. This has disrupted travel, supply chains, and normal business activity. So this means that a pandemic affects both supply and demand. So next, we'll just briefly look at what a depression is. As a depression is a sustained, long-term downturn in economic activity, which is a more severe economic downturn than a recession. So depressions are normally characterized by their length, the extremely large increases in unemployment, more bankruptcies, a full unavailability of credit, and significantly reduced amounts of trade and commerce. Now, price deflation, financial crises, stock market crashes, and bank failures are common elements of a depression. For example, the Great Depression of the 1930s saw unemployment rates in the US of 25% and worldwide GDP fall by around 15%. So this contrasts to the Great Recession of 2008 to 2009, where worldwide GDP fell by only 1%. So thanks for watching. If you click on my website link in the description, there is a link which will give you a free share of up to £100 if you follow the instructions. But thanks for watching and see you soon. Bye.